In its broadest sense, investing is the deployment of capital with the expectation of generating returns over time. It is, from an objective standpoint, the discipline of resource allocation across temporal dimensions. All investment vehicles, regardless of asset class, market, or complexity, are subjects of this financial discipline. Investing examines the allocation of resources, the mechanisms that generate returns, and the principles that govern wealth accumulation. From individual securities to global capital markets, investing concerns itself with every level of financial intricacy. This wide scope has given rise to numerous specialized branches, including portfolio theory, security analysis, behavioral finance, and quantitative investing, each focused on particular aspects of capital markets and wealth building. The question then naturally arises, what do we mean by investment? While there is no single universally accepted definition that encompasses all forms, most investment activities share certain fundamental characteristics. First is capital commitment. Every investment requires the allocation of financial resources that could otherwise be deployed elsewhere or consumed immediately. Second is time horizon. All investments operate across temporal dimensions, whether measured in days, years, or decades. Third is the risk-return trade-off. Investment returns compensate investors for bearing uncertainty, with higher potential returns generally associated with greater risk. Fourth is liquidity variation. Investment vehicles differ substantially in the ease and speed with which they can be converted to cash. A stock trades in seconds, real estate in months. Fifth is return generation. Investments produce gains through some combination of income, such as dividends or interest, and appreciation, the increase in asset value over time. Sixth is market exposure. All investments exist within economic and market systems that influence their performance through factors beyond the investor's control. Lastly, there is ownership positioning. Investments represent either ownership claims, as with stocks, or debt claims, as with bonds, each conferring different rights and risk characteristics. This naturally leads us to the idea of hierarchical organization. In finance, investment activity is not a random collection of transactions, but is structured in a well-ordered hierarchy. This hierarchy spans multiple levels, beginning with individual securities at the most basic level and rising to the level of global capital allocation. From individual stocks or bonds, portfolios are formed. These portfolios are held by investors who collectively constitute markets. Markets operate within national economies which themselves interact in a global financial system. At the individual security level, specific instruments such as shares of stock or bonds represent claims on underlying assets or cash flows. These instruments possess distinct characteristics, including price, yield, volatility, and correlation with other securities. The security itself is the fundamental unit of investable capital. Some portfolios, such as mutual funds, are composed of hundreds of individual holdings. Others, including concentrated value portfolios, contain far fewer positions. Moving up, we arrive at the portfolio level. Here, individual securities group into collections designed to achieve specific objectives such as income generation, capital preservation, or growth. These portfolios combine different asset types arranged for particular risk and return profiles. Portfolios are then held by investors, whether individuals, institutions, or funds. At the market level, the aggregate buying and selling decisions of all investors establish prices through continuous interaction of supply and demand. Multiple markets for different asset classes, equities, fixed income, commodities, real estate operate simultaneously. These markets exist within national economies characterized by distinct regulatory frameworks, tax systems, and monetary policies. When combined with macroeconomic conditions and international capital flows, the result is a global financial system, a dynamic network of interconnected markets and economic forces. As we ascend through these levels, new characteristics emerge that were not present at lower levels. These are called emergent properties. For example, a diversified portfolio demonstrates risk characteristics not found in any individual security that comprises it. A single stock may exhibit annual volatility of 30%, yet a portfolio of 50 stocks might exhibit volatility of only 15%. Similarly, markets exhibit price efficiency that individual securities do not possess in isolation. The interaction of millions of investors processing vast amounts of information creates pricing mechanisms that no single participant could replicate. These emergent properties are a central concept in understanding portfolio construction and market behavior. Two foundational ideas in investing deserve particular attention: the time value of money and the principle of compound returns. They serve as cornerstones for understanding wealth accumulation and capital allocation. The time value of money establishes that a dollar available today possesses greater value than a dollar available in the future. This principle reflects three factors: the opportunity cost of foregone investment returns, the erosion of purchasing power through inflation, and the uncertainty inherent in future payment. Money received today can be invested to generate returns, making current capital more valuable than future capital. This concept underpins all investment valuation, whether pricing bonds, valuing stocks, or comparing investment alternatives. The principle of compound returns, often attributed apocryphally to Einstein as the most powerful force in the universe, describes the process by which investment gains themselves generate additional gains. A simple example illustrates this mechanism. An investment of $10,000 earning 10% annually grows to $11,000 after 1 year. In the second year, the 10% return applies not merely to the original $10,000 but to the full $11,000, generating $1,100. This compounding effect, modest in early periods, becomes substantial over extended time horizons. Over 30 years, that initial $10,000 compounds to approximately $174,000, a 17-fold increase driven entirely by the reinvestment of returns. The mathematics of compound growth explains why starting early, maintaining consistency, and extending time horizons proves so consequential for wealth accumulation. A core theme in investing is the organization of capital across these hierarchical levels, and central to this is what might be termed the diversification principle. All successful long-term investors, from individual savers to massive institutional funds, structure their holdings across multiple securities. This diversification rests on a fundamental insight that combining assets with imperfect correlation reduces portfolio risk without necessarily sacrificing returns. The principle emerged from mathematical work in the 1950s, demonstrating that portfolio volatility depends not only on individual security risk, but on how those securities move relative to one another. Two stocks might each exhibit high volatility individually, yet combined in a portfolio might produce more stable returns if their price movements offset one another. There is also a strong relationship between risk and return throughout investing. By examining historical data, we can observe consistent patterns. Assets that fluctuate more dramatically in value, exhibiting higher volatility, have historically generated higher average returns over long periods. Stocks with their substantial price swings have outperformed bonds. Bonds with their moderate volatility have exceeded returns on cash equivalents. This risk-return relationship reflects a fundamental principle of capital markets. Investors demand compensation for bearing uncertainty. The greater the uncertainty, measured through volatility or other risk metrics, the higher the expected return required to attract capital. These fundamental characteristics, this hierarchical organization, and these core principles form the foundation upon which all investment theory and practice rest. Yet understanding these foundations proves insufficient without examining how investment thinking developed historically. To understand modern investing, one must first consider the evolution of ideas, the key figures who shaped investment theory, and the gradual transformation from speculation to systematic analysis. This naturally leads us to the historical development of investment thought and the thinkers who established its foundational principles. The theory of investing has roots that stretch back to the earliest forms of commerce and capital exchange. Markets for securities emerged gradually from commodity trading and lending practices that characterized medieval and Renaissance commerce. However, the systematic study of investment principles, the rigorous application of analytical methods to security selection and portfolio management, is a relatively modern development spanning roughly the past century. The Amsterdam Stock Exchange, established in 1602 by the Dutch East India Company, represents the first formal market for trading company shares. Investors could purchase fractional ownership in the company's trading ventures, sharing in profits while bearing proportional risk of loss. This innovation separated ownership from direct operational control, allowing capital to flow to ventures without requiring investors to manage ships, negotiate with foreign merchants, or navigate treacherous seas themselves. Yet even in these early markets, speculation proved problematic. The tulip mania of 1637, during which tulip bulb prices reached extraordinary levels before collapsing catastrophically, demonstrated that market participants could lose sight of underlying value, bidding prices to unsustainable heights, driven by expectations of further price increases rather than fundamental worth. By the early 19th century, formal stock exchanges had emerged in major financial centres. The London Stock Exchange received formal recognition in 1801, consolidating trading that had previously occurred in coffeehouses and informal gatherings. The New York Stock Exchange, tracing its origins to the Buttonwood Agreement of 1792, was formally organised in 1817. These institutions provided standardized trading mechanisms, established rules governing transactions, and created transparent price discovery processes. Yet investment practice remained largely speculative. Participants focused on short-term price movements, sought inside information, and attempted to profit from others' mistakes. Systematic analysis of business fundamentals played minimal role in security selection. This began to change in the early 20th century through the work of Benjamin Graham. Born in 1894 in London and raised in New York following his family's immigration, Graham experienced firsthand the consequences of financial instability. His family lost substantial wealth during the Panic of 1907, an experience that shaped his later emphasis on capital preservation and margin of safety. After graduating from Columbia University, Graham worked on Wall Street, eventually establishing an investment partnership. His approach differed fundamentally from prevailing practice. Rather than speculating on price movements or relying on tips and rumours, Graham analysed company financial statements, calculating intrinsic value based on assets, earnings, and dividends. He purchased securities only when market price fell substantially below his calculated value, providing a margin of safety against analytical errors or adverse developments. Graham's methods, developed through the 1920s and refined after the devastating market crash of 1929, were codified in Security Analysis, published in 1934 with co-author David Dodd. This work established principles that transformed investment practice. Graham distinguished between investment, which involved thorough analysis and promised safety of principal with adequate return, and speculation, which lacked such analytical foundation. He emphasized that stocks represented fractional ownership of businesses, not mere pieces of paper to be traded based on price momentum. He developed metrics for evaluating whether securities traded above or below intrinsic value, focusing particularly on undervalued situations offering substantial safety margins. This approach, which came to be known as value investing, proved remarkably successful over subsequent decades and influenced generations of practitioners. While Graham established fundamental analysis and value investing principles, a different revolution was unfolding in academic circles. Harry Markowitz, born in 1927 in Chicago, approached investment from a mathematical perspective. His doctoral research at the University of Chicago addressed a question Graham had not fully answered. How should investors construct portfolios from individual securities? In 1952, Markowitz published a paper titled Portfolio Selection in the Journal of Finance that fundamentally altered investment theory. He demonstrated mathematically that portfolio risk depended not only on individual security volatility, but on correlations between securities. Two volatile stocks, if their price movements were inversely correlated, could combine to produce a less volatile portfolio. This insight led to the concept of efficient portfolios, combinations of securities that maximized expected return for a given level of risk or minimized risk for a given level of expected return. Markowitz's work established modern portfolio theory, proving that diversification across imperfectly correlated assets reduced portfolio volatility without necessarily sacrificing returns. This mathematical framework provided rigorous justification for the intuitive practice of not putting all eggs in one basket. The theory also introduced the concept of systematic and unsystematic risk. Unsystematic risk, specific to individual companies, could be eliminated through diversification. Systematic risk affecting all securities to varying degrees could not be diversified away and therefore commanded a risk premium in expected returns. For this work, Markowitz received the Nobel Prize in Economics in 1990, recognition of how thoroughly his insights had reshaped both academic finance and investment practice. Building on Markowitz's foundation, William Sharpe developed the capital asset pricing model in 1964. Sharpe, studying under Markowitz, sought to simplify portfolio theory's computational complexity while extending its insights. CAPM, as the model became known, described the relationship between systematic risk and expected return. The model introduced beta, a measure of how sensitive a security's returns were to overall market movements. A stock with beta of 1 moved in line with the market. A stock with beta greater than 1 exhibited more volatility, while beta less than 1 indicated less volatility than the market. CAPM predicted that expected returns should be proportional to beta, with higher systematic risk commanding higher expected returns. This provided a framework for evaluating whether securities were fairly priced relative to their risk characteristics. In contrast to these theoretical developments emphasizing diversification and risk management, Eugene Fama introduced a perspective that questioned whether active security selection could consistently outperform markets. Fama, working at the University of Chicago in the 1960s and 1970s, developed the efficient market hypothesis. This theory posited that market prices incorporated all available information rapidly and accurately. In an efficient market, securities were always correctly priced given available information, making it impossible to consistently identify undervalued or overvalued securities. Fama distinguished three forms of market efficiency: weak form efficiency, where prices reflected past price information; semi-strong efficiency, where prices reflected all publicly available information; and strong form efficiency, where prices reflected even private information. If markets were efficient, Fama argued, active management attempting to beat market returns would prove futile after accounting for costs and risks. This perspective, controversial among practitioners who earned livings through active security selection, nevertheless influenced investment practice profoundly. John Bogle, founder of the Vanguard Group, drew on efficient market theory to launch the first index mutual fund in 1975. Bogle reasoned that if markets were reasonably efficient and active managers rarely beat market returns consistently after fees, investors would benefit from simply holding all market securities in proportion to their market capitalizations. This passive approach, tracking market indices rather than attempting to beat them, offered extremely low costs and tax efficiency. The first index investment trust, later renamed the Vanguard 500 Index Fund, initially attracted derision from active managers who labelled it Bogle's folly. Yet the fund's consistent performance, typically exceeding 70 to 80% of actively managed funds, over long periods, due primarily to its cost advantage, vindicated the approach. Index investing grew from this modest beginning to command trillions of dollars by the early 21st century. These developments transformed investing from an intuitive art to a discipline grounded in mathematical principles and empirical evidence. Graham established that systematic analysis of business fundamentals could identify investment opportunities offering favorable risk-return characteristics. Markowitz proved mathematically that portfolio construction mattered as much as security selection, that diversification across imperfectly correlated assets reduced risk efficiently. Sharpe quantified the relationship between risk and expected return, providing tools for evaluating fair pricing. Farmer challenged the premise that active management could consistently add value, documenting the difficulty of beating market returns. Bogle translated theory into practice, demonstrating that investors could capture market returns efficiently through passive indexing. Yet even as these theoretical and practical advances accumulated, a fundamental question persisted. If markets were efficient, if active management rarely succeeded, if diversification and indexing offered such compelling advantages, why did so many investors continue to trade actively, to concentrate portfolios, to chase performance, and to make costly errors? The answer, emerging in the final decades of the 20th century, lay not in finance theory, but in psychology. The field of behavioral finance would demonstrate that investor behavior deviated systematically from rational models, that cognitive biases and emotional reactions influence decisions in predictable ways, and that understanding these patterns mattered as much as understanding portfolio theory or security analysis. To understand the principles that govern investment success, however, one must first examine the fundamental concepts themselves in detail. Risk and return, diversification, compound growth, time value of money, asset allocation. These terms appear frequently in investment discourse, yet their precise meanings and interrelationships require careful articulation. 5 fundamental concepts form the intellectual foundation of investment practice. Each concept operates according to distinct principles, yet they function together as an integrated framework governing capital allocation and wealth accumulation. These concepts, risk and return, diversification, compound growth, time value of money, and asset allocation, appear simple when stated abstractly, but reveal considerable depth upon examination. First is the relationship between risk and return. Risk in investment contexts refers to uncertainty regarding future outcomes, specifically the possibility that actual returns will differ from expected returns. This uncertainty manifests in various forms. Market prices fluctuate, sometimes dramatically. Companies fail, rendering equity holdings worthless. Borrowers default, leaving bondholders with partial recovery at best. Inflation erodes purchasing power, reducing real returns even when nominal returns appear satisfactory. Return represents the gain or loss on invested capital over a specified period, typically expressed as a percentage. A stock purchased for $100 that rises to $110 generates a 10% return, assuming no dividends. The fundamental principle governing risk and return states that higher expected returns require acceptance of greater risk. This relationship reflects the preferences of investors who, given choice between two investments offering identical expected returns, will invariably select the less risky option. Consequently, riskier investments must offer higher expected returns to attract capital. This risk premium, the additional return above the risk-free rate, compensates investors for bearing uncertainty. Historical data confirms this relationship. From 1926 through the present, United States stocks have generated average annual returns of approximately 10%, bonds approximately 5 to 6%, and Treasury bills roughly 3%. These figures align with risk levels, stocks exhibiting highest volatility, bonds moderate fluctuation, and Treasury bills minimal variation. Risk itself can be quantified through statistical measures, primarily standard deviation of returns. A security generating returns of 10% in one year, negative 5% the next, and 15% the third exhibits higher volatility than a security producing 8, 9, and 10% returns consecutively. Standard deviation captures this variability. Stocks historically exhibit annual standard deviations of 15 to 20%, indicating that in approximately 2/3 of years, returns fall within one standard deviation of the mean, while in 1/3 of years returns fall outside this range. This statistical framework allows investors to evaluate whether potential returns justify risks undertaken. Second is diversification, the practice of spreading capital across multiple securities rather than concentrating in single positions. The rationale derives from correlation patterns between security returns. If all securities moved in perfect lockstep, rising and falling together, diversification would provide no benefit. Portfolio volatility would simply equal the average volatility of constituent securities. However, securities do not move in perfect correlation. While broad market forces affect all stocks to some degree, company-specific factors cause individual returns to diverge. One firm discovers a profitable new product, while another faces regulatory difficulties. One industry benefits from demographic trends, while another confronts technological disruption. Diversification exploits these imperfect correlations. By combining securities whose returns do not move in perfect tandem, portfolio volatility can be reduced without necessarily sacrificing expected returns. The mathematics formalized by Markowitz demonstrate that portfolio risk depends not merely on individual security volatilities, but on the correlations between them. Two stocks each exhibiting 20% annual volatility might combine to produce a portfolio with only 15% volatility if their returns exhibit correlation of 0.5 rather than perfect correlation of 1.0. Research indicates that holding 25 to 30 stocks from different industries eliminates approximately 90% of company-specific risk, leaving only systematic market risk that affects all securities. This leads to an important distinction between two types of risk. Unsystematic risk, also called specific or idiosyncratic risk, affects individual companies. A pharmaceutical firm's drug candidate fails clinical trials. A retailer's expansion into new markets disappoints. A manufacturer faces product recalls. These risks, specific to individual situations, can be eliminated through diversification. Systematic risk, by contrast, affects all securities to varying degrees. Recessions reduce corporate earnings broadly. Interest rate increases affect bond prices universally. Inflation erodes real returns across asset classes. This systematic risk sometimes called market risk, cannot be diversified away. Investors holding diversified portfolios still experience returns fluctuating with overall market movements. Third is compound growth, the process by which investment returns generate additional returns over time. Simple interest applies the return rate only to initial principal. An investment of $10,000 earning 5% simple interest generates $500 annually, the same amount each year. Compound interest, by contrast, applies the return rate to both principal and previously earned returns. That same $10,000 earning 5% compounded annually produces $500 in the first year, but $525 in the second year, as the 5% return applies to $10,500. This difference appears modest initially, but becomes substantial over extended periods. The mathematics of compound growth follow an exponential function. The formula, future value equals present value, multiplied by 1 plus the rate of return raised to the power of the number of periods, captures this relationship. A useful approximation, the rule of 72, estimates doubling time by dividing 72 by the annual percentage return. At 8% annual return, capital doubles approximately every 9 years. At 12%, doubling occurs every 6 years. Over 30 years at 10% annual return, capital grows not threefold, as simple interest would suggest, but more than 17-fold. This exponential growth explains why starting early, maintaining consistent contributions, and allowing time for compounding proves so consequential for wealth accumulation. Fourth is time value of money, the principle establishing that capital available presently possesses greater value than identical capital available in the future. 3 factors account for this relationship. First, money received today can be invested to generate returns, making current capital more productive than future capital. Second, inflation erodes purchasing power over time, meaning future dollars buy less than present dollars. Third, uncertainty surrounds future payment, introducing risk that promised amounts may not materialize. These factors combine to establish that rational investors require compensation for delayed receipt of funds. This principle enables valuation of future cash flows. A payment of $1,000 receivable 1 year hence is worth less than $1,000 today. Precisely how much less depends on the discount rate, the rate of return available on alternative investments of similar risk. If comparable investments yield 5%, the present value of that future $1,000 equals approximately $952, calculated by dividing 1,000 by 1.05. For payments further in the future or higher discount rates, present values decline more substantially. This discounting mechanism underlies all security valuation, whether calculating bond prices from coupon payments and principal, estimating stock values from projected dividends, or evaluating real estate from anticipated rental income. Fifth is asset allocation, the distribution of portfolio capital across different investment categories or asset classes. These categories, primarily stocks, bonds, and cash equivalents, exhibit distinct risk and return characteristics. Stocks represent ownership in corporations, offering participation in earnings growth and carrying substantial volatility. Bonds represent loans to governments or corporations, providing regular interest payments with moderate risk. Cash equivalents, including money market funds and treasury bills, offer high liquidity and capital preservation with minimal returns. Alternative investments such as real estate, commodities, and private equity constitute additional categories, each with specific characteristics. Asset allocation decisions typically exert greater influence on portfolio performance than individual security selection within categories. A portfolio allocated 90% to stocks and 10% to bonds will exhibit dramatically different returns and volatility than a portfolio allocated 30% to stocks and 70% to bonds, regardless of which specific stocks or bonds are selected. This occurs because asset class returns show lower correlation than securities within classes. When stocks decline, bonds often remain stable or appreciate, providing ballast. When stocks surge, bond returns lag, moderating overall portfolio gains. Two primary approaches govern asset allocation decisions. Strategic allocation establishes long-term target percentages based on investor goals, time horizon, and risk tolerance. A young investor with decades until retirement might adopt 80% stocks, 15% bonds, and 5% cash. This allocation remains consistent across market cycles with periodic rebalancing to maintain target percentages as market movements cause drift. Tactical allocation, by contrast, makes shorter-term adjustments based on market conditions or valuations. An investor might increase stock allocation when equities appear undervalued or shift toward bonds when economic indicators suggest recession. Research generally supports strategic allocation for most investors, as tactical adjustments require accurate market timing that proves difficult to achieve consistently. These 5 concepts, risk and return, diversification, compound growth, time value of money, and asset allocation, form an interconnected system. Risk-return trade-offs determine expected performance of asset classes chosen through allocation decisions. Diversification within those classes reduces portfolio volatility. Compound growth magnifies returns over extended periods. Time value principles enable proper valuation of future cash flows. Together, these concepts provide the analytical framework necessary for systematic investing. Applying them requires specific investment vehicles through which capital is deployed into markets. Investment vehicles can be categorized into several primary types, each with distinct characteristics governing risk, return, liquidity, and legal structure. These classifications are not arbitrary, but reflect fundamental differences in the nature of underlying assets and the claims they represent. The primary categories, stocks, bonds, real estate, cash equivalents, and commodities, constitutes the building blocks from which portfolios are constructed. Stocks, also termed equities, represent fractional ownership in corporations. When an investor purchases shares, they acquire proportional claim on the company's assets and future earnings. This ownership confers certain rights, including voting on corporate matters and receiving dividends when distributed. Stock returns derive from 2 sources. Dividend payments provide income, typically distributed quarterly, representing portions of corporate profits returned to shareholders. Price appreciation generates capital gains when shares are sold for more than purchase price. Historically, total stock returns have been divided roughly equally between these sources, though individual companies vary substantially in their dividend policies. Stocks themselves can be categorized along multiple dimensions. By market capitalization, companies are classified as large cap, generally those exceeding $10 billion in market value, mid cap ranging from 2 to 10 billion, and small cap below 2 billion. Large cap stocks typically exhibit greater stability and liquidity, trading in high volumes with narrow bid-ask spreads. Small cap stocks, while more volatile, have historically generated higher average returns, a phenomenon termed the size premium. By type, common stock provides voting rights and variable dividends, while preferred stock offers fixed dividends, and priority in bankruptcy but typically lacks voting rights. Growth stocks, characterized by rapidly expanding revenues and earnings, typically pay minimal or no dividends, reinvesting profits to fund expansion. Value stocks, mature companies with stable earnings, generally pay consistent dividends and trade at lower price-to-earnings ratios. Bonds represent debt instruments through which investors loan capital to governments, municipalities, or corporations in exchange for periodic interest payments and eventual principal repayment. Unlike stocks, bonds confer no ownership rights. Bondholders are creditors, not owners, possessing legal claim to promised payments, but no participation in profits beyond contractual terms. A bond's characteristics are defined by several parameters. Face value, typically $1,000, represents the amount repaid at maturity. Coupon rate determines periodic interest payments, usually paid semi-annually. Maturity date specifies when principal is returned. Credit quality, rated by agencies such as Moody's and Standard & Poor's, assesses default probability. Government bonds, issued by national treasuries, generally carry minimal default risk, particularly those issued by stable developed nations. United States Treasury bonds are considered risk-free in nominal terms, as the government can theoretically print currency to meet obligations, though this provides no guarantee against inflation eroding real value. Corporate bonds carry higher yields than government bonds to compensate for default risk. High-grade corporate bonds from financially strong companies trade at modest yield premiums, while high-yield bonds, sometimes termed junk bonds, from financially weaker issuers offer substantially higher rates, reflecting elevated default probabilities. Municipal bonds, issued by state and local governments, often provide tax-exempt interest, making them attractive to investors in high tax brackets despite lower nominal yields. Bond prices move inversely to interest rates, a relationship fundamental to fixed income investing. When prevailing interest rates rise, existing bonds paying lower coupon rates become less attractive, causing prices to decline. When rates fall, existing bonds paying higher coupons become more valuable, pushing prices upward. This interest rate risk affects longer maturity bonds more severely than shorter maturities. A 30-year bond experiences far greater price volatility from rate changes than a 2-year bond, as the extended duration magnifies discounting effects. Real estate represents physical property, whether residential, commercial, or industrial. Real estate investment generates returns through rental income and property appreciation. Several characteristics distinguish real estate from financial securities. First is illiquidity. Selling property requires months, involving inspections, negotiations, financing arrangements, and closing procedures. Stocks sell in seconds. Second is high transaction costs. Purchasing property involves substantial fees for agents, attorneys, inspections, and taxes, often totaling 5 to 10% of purchase price. Third is leverage accessibility. Mortgage financing allows investors to control property worth several times invested equity, amplifying both gains and losses. Fourth is management requirements. Physical property demands maintenance, tenant relations, and operational oversight absent from financial securities. Direct property ownership, while potentially lucrative, requires substantial capital, expertise, and time commitment. Real estate investment trusts, known as REITs, provide alternative access. These publicly traded companies own and operate income-producing properties, distributing at least 90% of taxable income to shareholders as dividends to maintain favorable tax treatment. REITs trade like stocks, offering liquidity, diversification across multiple properties, and professional management. They enable real estate exposure without direct ownership responsibilities. Cash equivalents encompass highly liquid, low-risk instruments, including money market funds, treasury bills, and certificates of deposit. These vehicles prioritize capital preservation and liquidity over return generation. Money market funds invest in short-term debt securities, maintaining stable $1 per share net asset value while distributing interest income. Treasury bills, government obligations maturing in 1 year or less, trade at discount to face value, with the difference representing interest earned. Certificates of deposit, bank deposits earning specified interest rates, offer FDIC insurance up to regulatory limits. cash equivalent returns barely exceed inflation over extended periods, but their stability and immediate availability serve crucial portfolio functions, providing resources for emergencies, rebalancing opportunities, or living expenses without forcing liquidation of volatile assets at inopportune moments. Commodities represent physical goods, including precious metals, energy products, agricultural products, and industrial materials. Gold, silver, crude oil, natural gas, wheat, corn, copper, and lumber all trade in commodity markets. Investors rarely take physical delivery, instead trading futures contracts representing agreements to buy or sell specified quantities at predetermined prices on future dates. Commodity prices fluctuate based on supply and demand fundamentals, weather conditions affecting agriculture, geopolitical events influencing energy, and currency movements affecting international trade. Commodities exhibit low or negative correlation with stocks and bonds, providing diversification benefits. Gold particularly serves as inflation hedge and safe haven during financial turmoil, often appreciating when stocks decline. However, commodities generate no income, produce no earnings, and offer no cash flows. Returns derive entirely from price appreciation, making valuation challenging and volatility substantial. Transaction costs in commodity markets, including futures contract rollover expenses, can be significant. Though fundamentally different in structure, risk characteristics, and return generation mechanisms, these asset classes share certain properties. All fluctuate in value, though volatility magnitudes differ substantially. All can be combined within portfolios to achieve desired risk-return profiles. All generate returns through some combination of income and appreciation, with proportions varying by asset type. The manner in which these assets are allocated within portfolios exerts dominant influence on portfolio performance characteristics, typically exceeding the impact of specific security selection within categories. Understanding how individual securities within these classes trade requires examination of market mechanisms themselves. Stock markets, representing the most liquid and actively traded investment venue, provide instructive example of how prices are discovered, how orders are matched, and how vast amounts of capital change hands efficiently each trading day. Stock markets are complex systems composed of numerous participants, mechanisms, and rules that together facilitate the transfer of ownership in publicly traded corporations. Though seemingly abstract when discussed in principle, these markets operate through concrete processes and specific institutional structures that can be examined systematically. At the center of stock market activity lie exchanges, organized venues, where securities are bought and sold. The New York Stock Exchange, established in 1817 and located on Wall Street in Manhattan, operates as an auction market where designated market makers facilitate trading on the physical trading floor, though most transactions now occur electronically. The Nasdaq, founded in 1971, functions entirely as an electronic network, matching orders through computer systems without physical trading floor. Companies seeking to list shares on exchanges must meet specific requirements regarding market capitalization, share price, financial performance, and corporate governance. These listing standards vary by exchange, with NYSE generally demanding higher thresholds than Nasdaq. Regular trading occurs during standard hours, 9:30 a.m. to 4 p.m. Eastern Time on weekdays, though extended trading sessions before and after these hours accommodate limited activity. When investors wish to buy or sell shares, they submit orders through brokerage accounts. These orders take various forms, depending on desired execution parameters. Market orders instruct immediate execution at prevailing market price, whatever that price may be. An investor placing market order to purchase 100 shares accepts the current asking price. the lowest price at which sellers are willing to sell. Market orders guarantee execution, but not price. Limit orders, by contrast, specify maximum purchase price or minimum sale price. A limit order to buy at $50 executes only if shares become available at $50 or less. This provides price protection, but does not guarantee execution, as the specified price may never materialize. Stop-loss orders trigger market orders when prices reach specified levels, typically used to limit losses on existing positions. If shares purchased at $60 decline to $55, a stop-loss order at $55 triggers sale, preventing further decline exposure. Multiple categories of participants populate stock markets, each serving distinct functions. Retail investors, individuals, trading personal accounts, constitute one segment. These participants typically execute smaller transactions, hold positions for varying time horizons, and make decisions based on diverse motivations including retirement planning, wealth accumulation, or speculation. Institutional investors, including mutual funds, pension funds, insurance companies, and endowments, trade far larger positions and employ professional managers. Their activities dominate market volume, with institutional trades often involving millions of shares. Market makers, whether exchange specialists or electronic firms, provide liquidity by continuously quoting prices at which they will buy and sell. They profit from bid-ask spreads while facilitating smooth market operation. High-frequency trading firms, utilizing sophisticated algorithms and high-speed connections, execute thousands of trades per second, capitalizing on tiny price discrepancies and providing liquidity, though their activities remain controversial. Price discovery, the process by which markets determine fair value for securities, occurs through continuous interaction of supply and demand. At any moment, each stock has a bid price, the highest price buyers will pay, and an ask price, the lowest price sellers will accept. The difference, known as the bid-ask spread, represents the transaction cost of trading. Heavily traded stocks exhibit tight spreads, often just 1 cent per share, while thinly traded securities may show spreads of several percentage points. When a market order arrives, it executes against the best available price on the opposite side. A market buy order transacts at the current ask price. A market sell order transacts at the current bid price. As orders arrive continuously throughout the trading day, prices adjust to reflect changing supply and demand. Strong demand with limited supply pushes prices higher. Abundant supply with weak demand drives prices lower. This continuous auction process incorporates new information rapidly. Earnings announcements, economic data releases, analyst recommendations, and company-specific news all trigger trading activity as investors reassess valuations. The efficiency with which prices adjust to information varies by stock, with larger, heavily followed companies generally exhibiting more efficient price discovery than smaller, obscure firms. The mechanics of executing trades involve several stages beyond initial order placement. Once an order matches with a counterparty, the trade enters clearing, the process of reconciling and confirming transaction details between buyer and seller. Clearing houses act as intermediaries, becoming buyer to every seller and seller to every buyer, guaranteeing trade completion even if one party defaults. Settlement, the actual transfer of securities and cash, occurs on a T+2 basis in United States markets, meaning 2 business days after trade date. An investor purchasing shares on Monday receives securities and remits payment on Wednesday. This delay, while seemingly archaic in an era of instant digital communication, allows time for clearing processes and funds transfers between institutions. Following settlement, securities are held in custody, typically at the investor's brokerage firm, with ownership recorded electronically rather than through physical certificates. Market indices provide benchmarks for measuring market performance and serve as basis for index funds. The Standard & Poor's 500, commonly known as the S&P 500, tracks 500 large capitalization United States stocks weighted by market capitalization. Larger companies exert proportionally greater influence on index movements. The Dow Jones Industrial Average, oldest continuing United States market index, comprises 30 large companies weighted by share price rather than market capitalization, an idiosyncratic methodology that gives higher-priced stocks greater influence regardless of company size. The Nasdaq Composite tracks all stocks listed on the Nasdaq exchange, heavily weighted toward technology companies. These indices serve multiple purposes, including performance measurement, passive investing through index funds, and derivatives underlying futures and options contracts. These mechanisms, while complex in their detailed operation, serve singular purpose: matching buyers and sellers efficiently and establishing prices through continuous auction. The market as whole functions as information processing system, incorporating news, earnings reports, economic data, and investor sentiment into prices moment by moment. This process, occurring thousands of times per second across thousands of securities, allocates capital toward enterprises investors value most highly, while enabling portfolio adjustments as circumstances change. Understanding market mechanics proves necessary but insufficient for investment success. Knowing how to trade does not indicate what to trade or in what proportions. This brings us to portfolio construction principles, the systematic methods by which individual securities are combined into integrated holdings designed to achieve specific risk and return objectives. Portfolio construction, the process by which individual securities are combined into integrated holdings, follows systematic principles derived from modern portfolio theory. This process occurs through deliberate methods designed to optimize the risk-return characteristics of the combined position. The construction of portfolios requires attention to diversification strategies, allocation frameworks, periodic maintenance, and correlation management. Diversification strategies operate at multiple levels simultaneously. Within asset classes, investors spread holdings across numerous individual securities to eliminate company-specific risk. A stock portfolio might contain 30 to 50 positions drawn from different industries, reducing exposure to any single firm's fortunes. Across asset classes, capital is distributed among stocks, bonds, and alternative investments, each responding differently to economic conditions. Geographic diversification extends holdings beyond domestic markets to capture international growth opportunities and reduce dependence on single national economy. Sector diversification ensures that portfolio performance does not depend excessively on particular industries. A portfolio concentrated in technology stocks, for instance, would suffer disproportionately if that sector declined, while a portfolio balanced across technology, healthcare, financial services, consumer goods, and energy would experience more stable aggregate returns. The effectiveness of diversification depends critically on correlations between holdings. Correlation coefficients, ranging from -1 to +1, measure how closely two securities move together. Perfect positive correlation of 1 indicates securities move in lockstep. Perfect negative correlation of -1 indicates securities move in opposite directions. Correlation of 0 indicates no consistent relationship. Most stocks exhibit positive correlations with one another, typically ranging from 0.5 to 0.8 as they respond to common market forces. However, these imperfect correlations provide diversification benefits. International stocks show correlations with United States stocks of approximately 0.7, while bonds exhibit correlations with stocks near 0.3 or even negative values during certain market conditions. By combining assets with lower correlations, portfolio volatility declines relative to individual security volatilities. Two distinct approaches govern asset allocation decisions within portfolio construction. Strategic allocation establishes long-term target percentages for each asset class based on investor characteristics, including age, risk tolerance, time horizon, and financial goals. A 35-year-old investor saving for retirement might adopt an allocation of 75% stocks, 20% bonds, and 5% cash equivalents. This allocation remains consistent across market cycles, providing discipline against emotional reactions to short-term market movements. The allocation typically becomes more conservative as investors age and their time horizons shorten. A 60-year-old approaching retirement might shift to 50% stocks, 40% bonds, and 10% cash, reducing volatility as the need to preserve capital intensifies. Tactical allocation, by contrast, makes shorter-term adjustments based on market valuations or economic forecasts. An investor employing tactical allocation might increase stock exposure when equity valuations appear low relative to historical norms, or shift toward bonds when economic indicators suggest recession. These adjustments typically remain within defined ranges around strategic targets, perhaps allowing stock allocation to vary between 60 and 80%, rather than remaining fixed at 70%. Research evidence suggests that tactical allocation rarely improves returns for typical investors. A successful implementation requires accurately predicting market movements, a skill that proves elusive even for professionals. Strategic allocation, maintained through disciplined rebalancing, generally produces superior long-term results. Rebalancing maintains target allocations as market movements cause drift. If stocks appreciate significantly while bonds remain stable, stock allocation might increase from target 70% to actual 80%. Rebalancing involves selling appreciated stocks and purchasing bonds to restore the 70-30 split. This systematic approach enforces the discipline of selling high and buying low, as rebalancing sells appreciated assets and purchases depreciated ones. Rebalancing can occur on calendar basis, perhaps annually or quarterly, or when allocations drift beyond threshold percentages, typically 5 percentage points. The optimal frequency involves balancing transaction costs and tax consequences against the benefits of maintaining target risk levels. Position sizing determines how much capital to allocate to individual securities within asset classes. Equal weighting assigns identical amounts to each holding, creating portfolio where a 50-stock portfolio places 2% in each position. Market capitalization, weighting used by index funds, allocates capital proportionally to company size, meaning larger companies receive larger allocations. Concentration limits prevent excessive exposure to single positions. Even if an investor has high conviction regarding a particular stock, prudent risk management typically caps individual positions at 5 to 10% of portfolio value, as concentrated positions amplify both potential gains and potential losses. Portfolio construction, while systematic in approach, requires both initial discipline and ongoing maintenance. The properly constructed portfolio exhibits characteristics including appropriate risk levels, reasonable expected returns, and stability through market cycles that no individual security possesses. These are emergent properties of the portfolio as whole, arising from thoughtful combination of components rather than inherent in any single holding. The portfolio functions. Portfolio as integrated system, with each element contributing to overall objectives while individual positions fluctuate independently. Constructing portfolios raises fundamental questions about how to evaluate the securities being combined. How does one assess whether individual stocks merit inclusion? What analytical frameworks distinguish promising investments from poor ones? These questions lead to fundamental analysis, the examination of companies through financial data and qualitative assessment. The analysis of individual securities begins with the understanding that a stock represents fractional ownership in an operating business. Yet this ownership is not random. Some businesses generate consistent profits and grow reliably, while others struggle or fail. Fundamental analysis seeks to distinguish between these outcomes through systematic evaluation of financial performance, competitive position, and growth prospects. The practice traces its origins to Benjamin Graham, born in 1894, who, working at Columbia University and managing investment partnerships during the 1920s and 1930s, established the analytical framework that transformed security analysis from speculation to discipline. Graham's approach, codified in Security Analysis published in 1934, emphasized rigorous examination of company financials to determine intrinsic value independent of market price. His methods focused on three primary sources of information: financial statements, valuation ratios, and qualitative business characteristics. Financial statements provide the raw data for fundamental analysis. The balance sheet presents a company's financial position at a specific moment, listing assets, liabilities, and shareholders' equity. Assets include cash, inventory, equipment, and property owned by the company. Liabilities encompass debts, accounts payable, and other obligations. Shareholders' equity, the difference between assets and liabilities, represents the residual claim of owners. The income statement, sometimes called profit and loss statement, reports revenues, expenses, and resulting profits over a specific period, typically a quarter or year. This statement reveals whether the company generates profits from operations and how efficiently it converts revenues into earnings. The cash flow statement tracks actual cash movements, distinguishing between operating activities, investing activities, and financing activities. This statement proves particularly important because accounting profits do not necessarily correspond to cash generation, and businesses ultimately require cash to sustain operations, service debt, and reward shareholders. From these statements, analysts derive valuation metrics that enable comparison across companies and assessment of whether current prices appear reasonable. The price-to-earnings ratio, calculated as share price divided by earnings per share, indicates how many dollars investors pay for each dollar of annual earnings. A company trading at $50 per share with earnings of $5 per share exhibits a P/E ratio of 10. Lower ratios suggest cheaper valuations, though context matters enormously. Rapidly growing companies command higher P/E ratios, often exceeding 30 or 40, while mature, stable businesses trade at ratios between 12 and 20. The price-to-book ratio compares market price to book value per share, where book value equals shareholders' equity divided by shares outstanding. This metric proves particularly relevant for asset-heavy businesses such as banks or manufacturers. The PEG ratio, price to earnings divided by earnings growth rate, attempts to adjust PE for growth, with ratios below 1 suggesting undervaluation relative to growth prospects. Dividend yield, calculated as annual dividend per share divided by share price, measures income return independent of price appreciation. A stock paying $2 annual dividend while trading at $40 yields 5%. Dividend yields vary enormously across companies and sectors, with mature businesses often yielding 3 to 5%, while growth companies pay little or nothing, preferring to reinvest all earnings. Free cash flow yield, calculated as free cash flow per share divided by price, indicates how much cash the business generates relative to market valuation. Profitability measures assess how effectively companies convert revenues into profits. Return on equity, net income divided by shareholders' equity, indicates how much profit the company generates on invested capital. ROE of 15 to 20% suggests strong profitability, while single-digit returns raise questions about capital efficiency. Return on assets, net income divided by total assets, measures profitability relative to all resources deployed. Profit margins, whether gross margins measuring profit after direct costs or net margins measuring profit after all expenses, reveal pricing power and cost discipline. Companies with high margins, perhaps 20 to 30% or more, typically possess competitive advantages, allowing premium pricing or exceptional efficiency. Growth analysis examines historical trends and future prospects. Revenue growth indicates whether the business is expanding its market presence. Earnings growth reveals whether expanding revenues translate to improved profitability. Historical patterns over 5 to 10 years provide context for evaluating sustainability. Companies demonstrating consistent double-digit growth command premium valuations, while erratic or declining growth rates typically trade at discounts. Beyond quantitative metrics, qualitative factors significantly influence investment quality. Management quality, though difficult to measure objectively, affects long-term outcomes substantially. Competent management allocates capital wisely, maintains appropriate financial leverage, communicates honestly with shareholders, and demonstrates strategic vision. Competitive advantages, sometimes termed economic moats, protect businesses from competitors and enable sustained profitability. These advantages might include brand recognition, proprietary technology, network effects, high customer switching costs, or regulatory barriers to entry. Industry position matters considerably. Market leaders typically demonstrate greater stability and profitability than marginal competitors struggling to differentiate their offerings. Comparative analysis places individual company metrics in context. Peer comparison evaluates companies against direct competitors in the same industry. A retailer's profit margins mean little in isolation, but become meaningful when compared to other retailers. Historical comparison assesses whether current metrics represent improvement or deterioration from companies' own past performance. Industry benchmarks provide reference points for determining whether observed characteristics appear typical or exceptional for the sector. Through fundamental analysis, investors attempt to determine intrinsic value, what a business is actually worth based on its operations, assets, and future prospects. This intrinsic value then serves as reference point against which market price can be compared, forming the basis for investment decisions. When market price falls substantially below calculated intrinsic value, Graham's margin of safety exists, suggesting attractive risk-reward characteristics. Understanding security analysis naturally raises questions about how such analysis is applied in practice. Different investors employ fundamentally different approaches, each grounded in distinct philosophies about markets, valuation, and return generation. Investment strategies can be organized into several foundational approaches, each addressing 3 central questions. What drives investment returns? How can returns be systematically captured? And what role do markets play in establishing fair prices? The answers to these questions vary substantially across approaches, producing distinct methods with different risk profiles, time horizons, and philosophical underpinnings. Value investing, the first major approach, traces its origins to Benjamin Graham's security analysis, published in 1934 during the depths of the Great Depression. Graham's fundamental insight held that stocks represent ownership in businesses possessing intrinsic value determinable through analysis of assets, earnings, and cash flows. When market prices fall below this intrinsic value, margin of safety exists. Graham sought companies trading at substantial discounts to calculated worth, providing cushion against analytical errors or adverse developments. His criteria often emphasized quantitative metrics such as low price-to-book ratios, low price-to-earnings ratios, strong balance sheets with minimal debt, and consistent dividend payments. This approach required patience, as undervalued securities might remain cheap for extended periods before market recognition occurred. Warren Buffett, born in 1930 and studying under Graham at Columbia University in the early 1950s, adapted and extended value investing principles. While Graham focused on statistical cheapness, often purchasing mediocre businesses at very low prices, Buffett emphasized quality, preferring wonderful businesses at fair prices over fair businesses at wonderful prices. His approach incorporated qualitative assessment of competitive advantages, management quality, and long-term economic characteristics. Buffett's investment partnership, established in 1956, and his later management of Berkshire Hathaway demonstrated value investing's effectiveness over decades, generating returns substantially exceeding market averages. Historical studies indicate that value stocks, those exhibiting low price-to-book or low price-to-earnings ratios, have outperformed growth stocks by approximately 2 to 3 percentage points annually from 1926 through present, though performance varies considerably across shorter periods. Growth investing represents a contrasting philosophy. Growth investors focus on companies demonstrating rapid revenue and earnings expansion, typically in emerging industries or those disrupting established markets. These investors willingly pay premium valuations, accepting high price-to-earnings ratios of 30, 50, or even higher, based on conviction that earnings growth will ultimately justify current prices. Technology companies frequently attract growth investors as their scalable business models and network effects enable rapid expansion. Growth stocks typically pay minimal or no dividends, reinvesting all earnings to fund continued growth. This approach carries higher volatility as high valuations leave little margin for disappointment. If projected growth fails to materialize, prices can decline precipitously. However, successful growth investments generate exceptional returns, with some technology leaders appreciating hundreds or thousands of percent over years. The philosophical distinction between value and growth investing reflects different beliefs about market efficiency and return sources. Value investors believe markets occasionally misprice securities, creating opportunities for those willing to conduct thorough analysis and exercise patience. They view returns as deriving from purchasing undervalued assets and waiting for market recognition. Growth investors emphasize identifying transformative businesses early, accepting high current valuations based on conviction about future prospects. They view returns as participation in genuine business growth rather than market mispricing correction. Index investing emerged from academic research on market efficiency and the difficulty of beating market returns. John Bogle, born in 1929 and founding Vanguard Group in 1974, launched the first index investment trust in 1975, the first index mutual fund available to individual investors. His reasoning is derived from several observations. First, actively managed funds rarely beat market indices consistently after fees. Studies indicate that over 15-year periods, approximately 80 to 90% of active managers underperform their benchmarks. Second, market efficiency makes sustained outperformance difficult, as widely available information gets incorporated into prices rapidly. Third, costs matter enormously, with management fees, transaction costs, and tax inefficiency eroding returns substantially over time. Index funds hold all securities in a market index, weighted by market capitalization, requiring minimal trading and virtually no research. This passive approach produces several advantages. Costs remain extremely low, often below 0.1% annually, compared to 1% or more for active funds. Tax efficiency improves dramatically, as infrequent trading generates fewer taxable gains. Portfolio turnover, the rate at which holdings are bought and sold, approaches single digits for index funds versus 50 to 100% or higher for active funds. Performance matches market returns by definition, minus minimal expenses. This simple approach, derided initially as settling for mediocrity, has proven remarkably effective, as matching market returns places an index fund in the top quartile of actively managed funds over most long-term periods. Dividend growth investing focuses specifically on companies paying consistent dividends that increase over time. This approach emphasizes established businesses with strong cash generation, returning capital to shareholders through quarterly payments. Dividend growth investors seek companies demonstrating multi-decade histories of annual dividend increases, suggesting durable competitive advantages and management commitment to shareholders. These companies, often termed dividend aristocrats, when possessing 25 consecutive years of increases, typically exhibit lower volatility than non-dividend paying stocks. The total return combines dividend yield, perhaps 2 to 4% annually, with capital appreciation and dividend growth. Reinvesting dividends compounds returns substantially over decades. Historical analysis indicates that dividend-paying stocks have generated roughly half of total stock market returns over the past century, with reinvested dividends contributing enormously to wealth accumulation. Momentum investing employs a fundamentally different approach, focusing on price trends rather than fundamental valuations. Momentum investors purchase securities exhibiting strong recent performance, based on observation that trends tend to persist over intermediate timeframes of 3 to 12 months. This approach has roots in technical analysis, but also connects to behavioral finance findings regarding investor underreaction to information and herding behavior. Momentum strategies typically involve shorter holding periods than value or growth approaches, rotating into new positions as trends change. Research documents a momentum premium, meaning stocks with strong recent performance continue outperforming on average, though with substantial volatility and occasional sharp reversals when trends break. Factor investing represents academic attempt to systematize return generation by identifying characteristics associated with higher returns. Extensive research has identified several factors or attributes that correlate with outperformance. The size factor indicates that smaller companies have historically outperformed larger companies by 2 to 3 percentage points annually, though with higher volatility. The value factor, low price to book or price to earnings ratios, has generated similar premiums. The momentum factor captures trend persistence. The quality factor emphasizes profitable, stable businesses with strong balance sheets. The low volatility factor, somewhat paradoxically, indicates that less volatile stocks have generated returns comparable to more volatile stocks, despite lower risk, violating standard risk-return assumptions. Factor-based strategies construct portfolios tilted toward these characteristics, seeking to capture associated premiums systematically. This approach bridges active and passive investing, maintaining broad diversification, like index funds, while targeting specific return sources like active management. Exchange-traded funds implementing factor strategies have proliferated in recent decades, offering investors systematic exposure to academic research findings. These strategies, while distinct in approaches and philosophical foundations, share certain characteristics. All require discipline, as attractive opportunities often appear least appealing when available and most appealing when disappearing. All demand patience, as intended results materialize over years or decades rather than weeks or months. All involve trade-offs, with no approach dominating across all market conditions. Value investing may underperform during speculative manias when growth stocks soar. Growth investing suffers disproportionately during market crashes when high valuation stocks decline most. Index investing guarantees average returns, foregoing possibility of exceptional outperformance. Dividend investing may lag when non-dividend paying growth stocks lead markets. Momentum investing experiences painful reversals when trends break. The choice among strategies depends on investor temperament, conviction, and circumstances. Value investing demands contrarian mindset and patience to hold unpopular positions. Growth investing requires comfort with volatility and conviction regarding long-term trends. Index investing offers simplicity and reliability at cost of surrendering active upside potential. Dividend investing suits those prioritizing income stability. Momentum investing demands systematic discipline and willingness to cut losses quickly. No approach eliminates risk or guarantees success, yet each has demonstrated capacity to generate satisfactory returns when properly applied over appropriate time horizons. Moving beyond these foundational strategies leads to more specialized investment vehicles and techniques. Options, futures, derivatives, leverage, and alternative investments offer sophisticated tools for expressing market views, managing risk, or enhancing returns. These advanced instruments introduce complexities and risks absent from traditional stock and bond investing. Beyond traditional stocks and bonds lie more complex investment instruments. These advanced vehicles serve specialized purposes, including risk management, leverage application, access to alternative return sources, and expression of sophisticated market views. Their complexity demands careful understanding of both mechanics and risk characteristics, as improper use can result in substantial capital loss. Options represent contracts conferring rights to buy or sell underlying securities at specified prices within defined timeframes. A call option grants the purchaser right to buy the underlying security at the strike price before expiration. An investor purchasing a call option on a stock currently trading at $50 might select a strike price of $55 with expiration 3 months hence. If the stock rises above $55 before expiration, the option holder can exercise the right to purchase at $55 regardless of current market price, capturing the difference as profit. If the stock remains below $55, the option expires worthless, and the buyer loses only the premium paid for the option. Put options grant the right to sell at the strike price, providing profit when underlying securities decline below the strike. Option pricing reflects multiple factors. Intrinsic value represents profit available from immediate exercise. A call option with strike of 50 on stock trading at 55 possesses $5 intrinsic value. Time value, the additional amount beyond intrinsic value, reflects probability of further favorable movement before expiration. Options with months until expiration command higher premiums than those expiring in days. Volatility of the underlying security affects pricing substantially, as greater price fluctuation increases probability of profitable exercise. Higher volatility raises option premiums for both calls and puts. Options enable various strategies beyond simple directional speculation. Covered call writing involves owning stock while selling call options against the position, generating income from option premiums while capping upside potential if the stock rises above the strike price. Protective puts function as insurance, granting stock owners right to sell at predetermined prices, limiting downside risk while maintaining upside participation. These strategies appeal to investors seeking to enhance income or manage risk within existing portfolios. However, options introduce complexities, including expiration management, premium erosion through time decay, and leverage characteristics that amplify both gains and losses relative to simple stock ownership. Futures contracts represent standardized agreements to buy or sell specified quantities of commodities or financial instruments at predetermined prices on future dates. Unlike options conferring rights, futures impose obligations. Both buyer and seller must fulfill contract terms at expiration, unless positions are closed beforehand through offsetting transactions. Commodity futures cover agricultural products such as corn, wheat, and soybeans, energy products, including crude oil and natural gas, metals like gold and copper, and livestock. Financial futures track stock indices, treasury bonds, and currencies. Futures trading requires posting margin, a performance bond ensuring contract fulfillment. Initial margin, typically 5 to 15% of contract value, must be deposited when opening positions. If positions move unfavorably, margin calls demand additional capital to maintain required levels. This leverage amplifies returns dramatically. A 10% move in underlying commodity translates to 100% gain or loss on posted margin for a position leveraged 10 to 1. This characteristic makes futures attractive to speculators seeking magnified exposure, while simultaneously introducing substantial risk of rapid capital depletion. Derivatives, the broader category encompassing options, futures, and related instruments, derive value from underlying assets without requiring direct ownership. Swaps exchange cash flows between parties, such as fixed-rate interest payments for floating-rate payments. Forward contracts function like futures, but trade over the counter with customized rather than standardized terms. Credit default swaps provide insurance against bond defaults. These instruments serve essential functions in modern finance, enabling risk transfer between parties with different exposures and preferences. However, they also introduce counterparty risk, the possibility that the other party to a contract fails to meet obligations. The 2008 financial crisis illustrated how interconnected derivative positions can amplify systemic instability when counterparties prove unable to honor commitments. Leverage, the use of borrowed capital to increase position size, appears throughout advanced investing. Margin accounts allow stock investors to borrow against existing holdings, typically up to 50% of portfolio value, effectively doubling purchasing power. Real estate investors routinely employ mortgage financing, controlling properties worth several times invested equity. Leverage magnifies both gains and losses proportionally. An investor using 2 to 1 leverage experiences 20% return when underlying assets appreciate 10%, but suffers 20% loss when assets decline 10%. Interest costs on borrowed capital further erode returns. Leverage proves particularly dangerous during market declines, as falling values can trigger margin calls, forcing liquidation of positions at unfavorable prices, locking in losses that might otherwise prove temporary. Alternative investments encompass asset classes beyond traditional stocks and bonds. Private equity involves ownership stakes in non-publicly traded companies, acquired either through venture capital investments in startups or leveraged buyouts of established businesses. These investments typically require multi-year holding periods with no interim liquidity and minimum commitments, often exceeding $1 million. Hedge funds employ diverse strategies including long-short equity, global macro, arbitrage, and quantitative approaches, charging substantial fees typically structured as 2% of assets annually plus 20% of profits. Access remains restricted primarily to accredited investors meeting net worth or income thresholds. Real estate can be accessed through direct property ownership, private real estate funds, or publicly traded REITs discussed earlier. Commodities provide inflation hedging and portfolio diversification, but generate no income and involve storage costs or futures rolling expenses. Alternative investments appeal through their potential for return enhancement and low correlation with traditional assets. Private equity has historically generated returns exceeding public equity markets by several percentage points annually, though with higher volatility and complete illiquidity during holding periods. Hedge funds promise absolute returns uncorrelated with market direction, though actual results vary enormously across funds and strategies. However, alternative investments introduce specific risks and limitations. High fees erode returns significantly, with typical hedge fund fees consuming 3 to 4 percentage points annually before investor profits. Illiquidity prevents portfolio adjustments when circumstances change or better opportunities emerge. Valuation proves difficult in the absence of market prices, creating potential for delayed recognition of losses. Due diligence requires substantial expertise, as complex strategies and opaque structures complicate assessment of true risks. The mechanics of these advanced instruments vary considerably in detail, yet certain principles apply universally. All introduce leverage explicitly or implicitly, magnifying both positive and negative outcomes. All require sophisticated understanding, extending beyond basic stock and bond investing. All involve higher costs through fees, spreads, or financing expenses. All carry risk of substantial or total capital loss under adverse scenarios. The investor who approaches these instruments without thorough comprehension of mechanics and risks courts serious financial harm. Conversely, informed investors can employ advanced instruments constructively. Options enable income generation through covered call, writing or portfolio protection through protective puts. Futures allow efficient hedging of currency or commodity exposures for businesses or investors. Derivatives facilitate risk transfer to parties willing to bear specific exposures. Leverage, applied judiciously with careful attention to risks, can enhance returns when conviction and circumstances justify its use. Alternative investments provide diversification and potential return enhancement for investors with appropriate capital, time horizon, and sophistication. These tools, properly understood and carefully applied, expand the investment opportunity set. Yet even comprehensive knowledge of vehicles, strategies, and market mechanics proves insufficient for consistent success. The human investors deploying these tools bring psychological tendencies and behavioral patterns that often undermine rational decision-making. Understanding these behavioral factors, acknowledging their influence, and implementing systematic approaches to counter their effects may prove more consequential than mastery of technical concepts. Investors may be rational in theory, yet in practice they demonstrate systematic deviations from rationality. These deviations, far from being random, follow predictable patterns that affect investment decisions and portfolio performance. The field of behavioral finance, emerging in the late 20th century through work of psychologists and economists, documents these patterns and their consequences for wealth accumulation. Daniel Kahneman, born in 1934 in Tel Aviv, and Amos Tversky, born in 1937 in Haifa, working initially as psychologists rather than economists, began studying decision-making under uncertainty in the 1970s. Their research demonstrated that human judgment departs systematically from the rational models assumed by traditional economics. People employ mental shortcuts called heuristics that, while useful in many contexts, produce predictable errors in others. These cognitive biases affect decisions across domains, but prove particularly costly in investment contexts where errors compound over time through market mechanisms. Cognitive biases affecting investors can be categorized into several types. Confirmation bias leads investors to seek information supporting existing beliefs while discounting contradictory evidence. An investor convinced that technology stocks will continue appreciating attends selectively to positive news while dismissing warnings, maintaining conviction despite accumulating contrary evidence. Anchoring causes investors to fixate on specific reference points, typically purchase prices, even when those points lack relevance to current value. An investor who purchased shares at $60 may refuse to sell at $55, viewing the position as a loss relative to the arbitrary anchor rather than evaluating current prospects objectively. The stock's fair value might be $40, making $55 an attractive exit, yet anchoring to $60 prevents rational action. Recency bias overweights recent experiences relative to longer historical patterns. After several years of strong stock returns, investors extrapolate recent performance indefinitely, assuming elevated returns represent new normal rather than temporary condition likely to revert toward historical averages. Conversely, following market declines, investors project continued losses despite historical evidence that markets recover over time. This bias contributes to buying near market peaks when confidence runs high and selling near market troughs when pessimism prevails, precisely the opposite of profitable behavior. Loss aversion, perhaps the most consequential bias, describes the tendency for losses to generate roughly twice the emotional impact of equivalent gains. Losing $1,000 produces more pain than gaining $1,000 produces pleasure. This asymmetry causes investors to hold losing positions too long, hoping for recovery to avoid realizing losses, while selling winning positions too quickly to lock in gains and avoid risk of reversal. The result is portfolios filled with deteriorating holdings, while successful investments are prematurely eliminated. Research demonstrates that individuals confronting identical expected values make different decisions depending on whether outcomes are framed as gains or losses, with loss framing producing risk-seeking behavior and gain framing producing risk-averse behavior. Overconfidence leads investors to overestimate their knowledge, analytical abilities, and predictive accuracy. Studies indicate that when people estimate confidence intervals for uncertain quantities, actual values fall outside stated ranges far more frequently than probability theory predicts, revealing systematic overconfidence in judgment accuracy. In investment context, overconfidence manifests as excessive trading, concentrated portfolios, and inadequate consideration of downside risks. Investors trade frequently, believing they can identify mispriced securities, despite evidence that such skill proves extremely rare. They concentrate holdings in a few stocks based on conviction regarding individual analysis, despite portfolio theory demonstrating that diversification reduces risk efficiently. Herd behavior describes the tendency to follow crowds rather than making independent judgments. When many investors purchase particular stocks or sectors, others follow, fearing to miss opportunities or assuming crowd wisdom exceeds individual judgment. This behavior drives asset bubbles as prices rise beyond rational valuations sustained solely by expectations of continued appreciation. Eventually, fundamentals reassert themselves, bubbles collapse, and late entrants suffer substantial losses. The dot-com bubble of the late 1990s illustrates this pattern dramatically. Technology stocks, particularly internet companies, with minimal or no profits, reached extraordinary valuations as investors projected unlimited growth potential. The Nasdaq Composite Index, heavily weighted toward technology, peaked above 5,000 in March 2000 before collapsing to approximately 1:100 by October 2002, a decline exceeding 75%. Many individual stocks declined 90% or more. Investors who purchased during speculative peak endured devastating losses. The housing bubble culminating in 2008 demonstrated similar dynamics. Home prices appreciated rapidly, through the mid-2000s, sustained by declining lending standards, speculation, and belief that prices would continue rising indefinitely. When prices peaked and began declining, foreclosures accelerated. Financial institutions holding mortgage-backed securities faced massive losses, and the resulting crisis triggered the deepest recession since the 1930s. Stock markets declined approximately 50% from peak to trough, with many investors selling near the bottom after panic overwhelmed rational assessment. Emotional reactions amplify these cognitive biases. Fear and greed drive decision-making during market extremes. When markets surge, greed encourages risk-taking as investors extrapolate gains indefinitely and worry about missing further appreciation. When markets plunge, fear induces selling as investors project continued losses and prioritize avoiding further pain over capturing eventual recovery. These emotional responses occur despite historical evidence that markets fluctuate substantially over short periods while trending upward over decades. From 1926 through present, the S&P 500 has experienced intra-year declines averaging 14%, even in years finishing positive. Declines of 20% or more, termed bear markets, occur approximately once every 5 years. Yet over rolling 20-year periods, stocks have produced positive real returns in virtually all cases, rewarding investors who maintain discipline through volatility. Market timing attempts, the effort to shift between stocks and cash based on market forecasts, represent perhaps the most consistent behavioral error. Studies demonstrate that investors who attempt timing capture substantially lower returns than buy and hold investors, despite market timing's intuitive appeal. The difficulty lies in requiring two correct decisions, when to exit and when to re-enter, with severe consequences from errors. Missing just the 10 best return days over multi-decade periods reduces total returns by approximately 50%. Those best days often occur during periods of maximum pessimism when investors feel least inclined to hold stocks. Mental accounting, treating money differently based on source or designation, causes irrational behavior. Investors might take excessive risks with unexpected windfalls while remaining conservative with salary savings, despite money being fungible. They might hold losing positions in taxable accounts to avoid realizing capital losses for psychological reason, while simultaneously holding gains, paying unnecessary taxes through failure to harvest losses that could offset gains elsewhere. Systematic approaches counter these behavioral tendencies. Rules-based investing removes discretion, establishing predetermined criteria for buying, selling, and position sizing that prevent emotional override during stress. An investor might establish rules requiring portfolio rebalancing whenever allocations drift 5 percentage points from targets, enforcing contrarian behavior of selling appreciated assets and buying depreciated ones regardless of current sentiment. Automatic rebalancing through target date funds or robo-advisors implements this discipline without requiring active decisions during periods of emotional intensity. Written investment policy statements, documents articulating goals, risk tolerance, time horizon, and strategic allocation provide reference points during market turmoil. When markets decline and fear suggests selling, reviewing the policy statement reminds investors of long-term objectives and predetermined strategies, countering impulses toward panic-driven action. Dollar cost averaging, investing fixed amounts at regular intervals regardless of prices, removes timing decisions while ensuring continued capital deployment during market declines when valuations improve. Perhaps most importantly, understanding that behavioral errors are natural human tendencies rather than personal failings enables investors to implement systematic defenses. Recognizing anchoring allows conscious effort to evaluate positions based on current prospects rather than purchase prices. Acknowledging loss aversion permits active management of loss-selling and gain-holding tendencies. Accepting that overconfidence affects judgment encourages humility in predictions and appropriate diversification despite conviction regarding individual analysis. Behavioral biases, while deeply rooted in human psychology, need not doom investors to poor outcomes. The investor who acknowledges these biases, who implements systematic processes to counter them, and who maintains discipline through market cycles can achieve satisfactory results. This discipline, perhaps more than analytical skill or market knowledge, separates successful long-term investors from unsuccessful ones. The mechanics are learnable, the strategies are documented, yet the behavioral discipline remains the persistent challenge. Even the disciplined investor implementing sound strategies faces genuine risks beyond psychological pitfalls. Market downturns destroy capital. Inflation erodes purchasing power. Unexpected expenses demand liquidity at inopportune moments. The inevitable approach of retirement requires systematic withdrawal planning. These concrete challenges demand specific risk management techniques and protection strategies. All investors face threats to capital preservation and wealth accumulation. Market downturns reduce portfolio values precipitously, sometimes exceeding 50% from peak to trough. Inflation erodes purchasing power steadily, transforming seemingly adequate savings into insufficient resources over decades. Excessive spending depletes assets regardless of investment returns. Poor security selection destroys capital through bankruptcy and permanent impairment. Behavioral errors compound losses through ill-timed decisions. Inadequate planning leaves investors unprepared for retirement, major expenses, or estate transfer. To manage these threats, investors employ multiple layers of defense, each addressing specific categories of risk. The first layer consists of asset allocation and diversification, broad protections operating continuously regardless of specific market conditions. Proper allocation across stocks, bonds, and cash equivalents provides ballast during market stress. When stocks decline sharply, bonds often remain stable or appreciate as investors seek safety and central banks reduce interest rates. A portfolio allocated 60% to stocks and 40% to bonds experiences substantially smaller drawdowns than a portfolio allocated entirely to stocks. During the 2008 financial crisis, the S&P 500 declined approximately 57% from peak in October 2007 to trough in March 2009. A balanced portfolio of 60% stocks and 40% bonds declined roughly 35%, still painful, but significantly less devastating, and requiring smaller subsequent gains for recovery. Diversification within asset classes further reduces risk, as discussed previously, by eliminating company-specific risks through holding numerous positions across sectors and geographies. The second layer includes position sizing, stop-loss disciplines, and active monitoring. Position sizing limits prevent excessive concentration in single holdings. Even high-conviction positions typically should not exceed 5 to 10% of portfolio value, ensuring that individual security failures cannot cause portfolio-level catastrophe. Stop-loss orders, either literal orders placed with brokers or mental disciplines enforced through regular review, limit losses on individual positions. An investor might establish a rule requiring sale of any position declining 25% from purchase price, preventing occasional poor decisions from compounding into ruinous losses. Active monitoring enables recognition of deteriorating fundamentals, changing competitive dynamics, or broken investment theses, prompting timely exits before losses accelerate. The third layer comprises hedging strategies and insurance products targeted at specific risks. Option strategies, including protective puts, provide portfolio insurance, limiting downside while maintaining upside participation. An investor holding substantial equity positions might purchase put options on market indices, paying premiums for contracts that appreciate when markets decline, offsetting portfolio losses. Currency hedging protects international investments from exchange rate fluctuations. Real assets, including commodities and real estate, hedge inflation risk. These targeted protections address specific concerns that broad diversification may not fully mitigate. Market risk, the possibility that overall market declines reduce portfolio values, affects all equity investors. Beta, measuring sensitivity to market movements, quantifies this exposure. A portfolio with beta of 1 moves in line with the market. Beta of 1.5 indicates 50% greater volatility than the market, amplifying both gains and losses. Investors can manage beta exposure through asset allocation decisions. Reducing stock allocation from 80% to 60% reduces market beta proportionally. Within equity allocations, favoring lower beta stocks, typically large cap value companies in defensive sectors like utilities and consumer staples, further reduces market sensitivity. Sector limits prevent concentration in cyclical industries like financials or technology that exhibit elevated market sensitivity. Geographic diversification across developed and emerging markets reduces dependence on any single economy, though correlations between markets have increased over recent decades, somewhat limiting diversification benefits. Inflation risk, the erosion of purchasing power over time, proves particularly insidious as effects accumulate gradually. At 3% annual inflation, purchasing power halves every 24 years. A retiree beginning retirement at age 65, with what appears adequate savings, may find resources severely depleted by age 85, simply through inflation, even before accounting for portfolio withdrawals. Stocks provide inflation protection through corporate pricing power and earnings growth that generally pace or exceed inflation over long periods. Real estate offers similar protection, as property values and rental income tend to rise with inflation. Treasury. Inflation-protected securities, known as TIPS, adjust principal values based on consumer price index, explicitly protecting against inflation while providing modest real yields. Commodities, particularly gold, have historically maintained purchasing power over very long horizons, though with substantial intermediate volatility. Retirement planning confronts multiple challenges, including determining adequate savings, managing sequence of returns risk, establishing sustainable withdrawal rates, and addressing required minimum distributions. Research on safe withdrawal rates, pioneered by financial planner William Bengen in the 1990s, suggests that 4% initial withdrawal rates from balanced portfolios, adjusted annually for inflation, provide high probability of portfolio survival over 30-year retirement periods. This 4% rule derives from historical analysis examining portfolio outcomes across various market environments. A retiree with $1 million might withdraw $40,000 in year 1, $41,200 in year 2, assuming 3% inflation, and so forth. This approach balances adequate income against portfolio preservation. Sequence of returns risk represents particular danger during retirement's early years. Market declines occurring immediately after retirement prove far more damaging than identical declines occurring later, as withdrawals force sale of depreciated assets, locking in losses. An investor experiencing negative returns in years 1 through 5, while making withdrawals, depletes principal substantially, leaving less capital to benefit from subsequent recovery. Bucket strategies address this risk by segregating portfolios into time-based allocations. Near-term buckets, covering 1 to 3 years of expenses, hold cash and short-term bonds, ensuring that market volatility does not force disadvantageous liquidations. Intermediate buckets, covering years 4 through 10, hold balanced allocations. Long-term buckets maintain equity-heavy allocations for growth. As near-term buckets deplete, they are replenished from intermediate and long-term buckets during favorable market conditions, avoiding forced sales during downturns. Tax management significantly impacts after-tax returns over time. Strategic asset location places tax-inefficient investments, like bonds generating ordinary income, into tax-deferred accounts, including traditional IRAs and 401k plans, while holding tax-efficient investments, like stocks generating capital gains and qualified dividends, in taxable accounts. Tax loss harvesting systematically realizes capital losses to offset gains elsewhere, reducing annual tax liabilities without changing portfolio exposures by immediately purchasing similar but not identical securities. Roth conversions, transferring assets from traditional IRAs to Roth IRAs by paying taxes on converted amounts. Benefit investors expecting higher future tax rates or seeking to eliminate required minimum distributions that begin at age 73. Estate planning ensures wealth transfers according to investor intentions while minimizing taxes and administrative burdens. Beneficiary designations on retirement accounts and insurance policies supersede will provisions, requiring careful coordination. Trusts provide control over distribution timing and conditions while potentially reducing estate taxes for substantial estates. Step up in basis at death eliminates capital gains, taxes on appreciated assets for heirs, suggesting strategies favoring holding appreciated positions until death over realizing gains during life when alternative uses for capital are limited. Insurance products address specific risks including premature death, disability, long-term care needs, and longevity. Term life insurance provides death benefit protection for specified periods at relatively low costs, appropriate for breadwinners with dependents. Permanent insurance, including whole life and universal life, combines death benefits with cash value accumulation, but carries substantially higher premiums. Disability insurance replaces income if injury or illness prevents work, typically replacing 60 to 70% of income. Long-term care insurance covers nursing home or in-home care costs that can devastate finances absent coverage. Annuities, insurance contracts, providing guaranteed income streams, address longevity risk by ensuring income regardless of lifespan. Fixed annuities provide specified payments. Variable annuities link payments to investment performance. Immediate annuities begin payments promptly, while deferred annuities start payments at future dates. Common pitfalls undermine even well-conceived plans. Excessive trading erodes returns through transaction costs and taxes while providing no systematic benefit. Studies demonstrate that turnover correlates negatively with returns as frequent traders capture poor results after costs. Chasing performance, purchasing last year's top performers, typically produces disappointing results as performance mean reverts. Inadequate emergency funds force liquidation of investments at inopportune times to meet unexpected expenses. Concentration risk, maintaining excessive exposure to single securities or sectors, eliminates diversification benefits. Failure to rebalance allows portfolio drift from strategic targets, often increasing risk as appreciated equities grow to dominate allocations. The mathematics of loss recovery illustrates why capital preservation matters enormously. A portfolio declining 50% from $100,000 to $50,000 requires 100% gain simply to recover to original value. Avoiding severe losses proves far easier than recovering from them. A portfolio declining 20% requires 25% gain for recovery. A portfolio declining 30% requires 43% gain for recovery. These asymmetries argue strongly for risk management prioritization, particularly for older investors with limited time to recover from setbacks. Despite its complexities, risk management follows systematic principles. The investor who maintains appropriate diversification across and within asset classes, who rebalances regularly to enforce disciplined buying and selling, who manages costs and taxes carefully, who maintains adequate insurance coverage, and who plans retirement withdrawals, methodically can navigate market cycles successfully. Though investment markets present genuine risks, though market timing proves difficult or impossible, though behavioral errors tempt even disciplined investors, and though no strategy guarantees wealth accumulation, the systematic application of sound principles has historically generated satisfactory outcomes over long time horizons. Many questions about optimal approaches remain subjects of ongoing debate. With advancing computational capabilities and expanding data sets, researchers continue to refine understanding of return sources, factor premiums, risk management techniques, and behavioral interventions. These developments, coupled with evolving market structures, including increased passive investing and algorithmic trading, ensure that investment theory and practice will continue developing. Yet the fundamental principles that diversification reduces risk efficiently, that compound growth builds wealth over extended periods, that costs erode returns substantially, and that discipline matters more than brilliance, appear unlikely to change. These principles, understood and applied patiently, form the foundation of successful long-term investing. In its broadest sense, investing is the deployment of capital with the expectation of generating returns over time. It is, from an objective standpoint, the discipline of resource allocation across temporal dimensions. All investment vehicles, regardless of asset class, market, or complexity, are subjects of this financial discipline.